Recording. So just let me know if you can all see my screen. Can you see my screen? Good. Okay, awesome. Okay, all right. So welcome everyone to this special presentation that we have on personal taxes. So as you all know, the tax season is here. It comes so quickly. And now we're, as a firm, we're getting ready to get started and start helping our clients with their taxes. So this evening, I'm going to be speaking with Nibia. So Nibia is a member of our team. So shortly, she will introduce herself. I'm going to introduce myself very quickly. So Ken Green, one of the partners here at the firm, GMS Professional Corporation. We've been in business since 2012 or 2013, so 11 years now, 11, 12 years. So that's been a long time. So I'm a CPA. Here, I worked with PricewaterhouseCoopers a couple of years ago in the downtown office, briefly in the US, came back and then went into banking. I did some banking for a number of years and then decided to go crazy and start the accounting firm with my crazy partner here, Celia. So we've been running this firm for the last 12, 13 years. And thank you for all our clients. Some of you have been with us from day one, and so we appreciate that. And thank you to all the new clients, people that continue to discover us each and every day. So at the firm, my focus is on personal taxes, corporate taxes, tax planning, just helping you as much as you can to save as much as you can with your taxes. So that's my focus here at the firm. And Nibia, I think you can introduce yourself, and then we'll take it up from there.
Okay, hi everyone. So my name is Nibia Dixon. I'm fairly new, but not that new to GMS. I started last year during their busy season. At GMS, I am responsible for their client service management. So I do a lot of bookkeeping, personal taxes that we'll be talking about today, HST, and other things as well. So I am a graduate of the University of Technology in Jamaica. I did a bachelor's in accounting. And I've been learning a lot here at GMS. Tax is my passion. I've started learning about taxes a few years ago, but I really put it into practice around a year and a half ago. So, yeah, in a snapshot, that's me, and I'll be happy to discuss in more tax with you as we go on today.
Okay, awesome, awesome. All right, thank you for that. Let's see, we know. What's my slide here? Okay, hold on. Let me just admit one person and then I can advance my slide. Okay, so for today, we're going to be talking about, I'll briefly go through a survey that we run almost every year here on personal tax survey. I'll go through the highlights of some of those results. And then we talk about some foundational things that I think everyone should know when it comes to personal taxes in Canada. And then Nibia and I briefly will go through what's new in 2023. We'll highlight some things that are relatively new, started in 2022, or some of the things that have been extended. So we'll highlight some of those as well. And then towards the end, we'll go through some personal tax planning tips. I'll talk briefly about tax efficiency, and then we'll share some information on how we can help you as a team. So this survey I run every year, and I like to find out, and I ask questions to a lot of Canadians and say, okay, what are your top 3 challenges, particularly when it comes to personal taxes? And so the result this year is not different from last year. Why? So the number one result is gathering and organizing documents. And I can tell you that personally, even us as accountants, we struggle with that. And I can really understand why clients and many people struggle with that. And we see it every day in our practice. It's always a challenge. It takes it takes a lot of effort to master this and to continue to do it consistently. Particularly when you have complex tax situation. Maybe you have a business, you have real estate, you have all these different investments. You got to think about how to document and put together things about your gains and losses, your trading transactions. So there's so many things to do when it comes to gathering your documents. And we'll go through some tips in terms of how you do that. This year, there was a tie for second and third, right? And this second one is I don't know where to start or what to do. Okay. And sort of this is sort of related to the third point, which says, well, I lack the knowledge of taxes. Okay, so these 2 points are not overly surprising to me. Tax is complex in this country. Some of you may have seen, I don't know, I don't have it there, I would have shown you how big is like twice the size of, or 3 times the size of a dictionary. So that's how crazy our tax act is, right? So I get it when people don't know where to start, they don't know what to do, when they're confused. And so that's why we are here to help as professionals, because we can help you navigate that. Right, so this is a big concern. A lot of people don't know what to do. They don't know where to start. And oftentimes, as a result of this, we'll find people that have not filed taxes for 5 years, 6 years, 7 years. So that happens sometimes, just simply because they don't know what to do or where to start. And this one, I don't blame people for this because tax, as I mentioned, is complex. It requires a lot of specialized knowledge. And so that is one of the reasons why we're here. That is one of the reasons why we're doing this seminar today, just to give you a little bit of knowledge about taxes, particularly personal taxes for today. As part of this survey, I give people the opportunity to ask questions. And oftentimes we get a lot of questions. So these are just sample of some questions that we got. I sort of put together the theme of the questions I got this year. A lot of them had to do with minimizing or saving on taxes, right? So people want to understand or they want to learn how to save taxes. So Canada is highly taxed. As you know, we are one of the we have high tax rates in this country compared to other countries around the world. And so I can understand when people really want to save taxes. And that's what I'm all about. That's what our firm is all about, trying to save you on taxes. How do I better understand tax issues, right? One of the reasons why we put seminars like this to help you answer some of those questions today. What are some applicable deductions and credits? And again, we'll go through that today. What do I do if I filed incorrectly, right? So all these questions I may not be able to answer today, but at least you will get some ideas for some of these questions today. How do I calculate my taxes? Again, something we'll talk about today. How do I get a higher tax refund? So this one is an interesting one. You know, people want to get higher tax refund. And I'll talk a little bit about that today. I don't think your goal should be to get a higher refund, right? So that shouldn't be a goal per se. If you're getting a higher refund, then there's really something wrong in terms when it comes to your planning. When is it a good idea to use Smith maneuver? So this one talks is more like financial planning. Again, something I can actually help with, but this will require one-on-one consultation. How can I reduce the amount of taxes I pay if I don't have a business? So it is true, if you don't have a business, your ability to reduce personal taxes would diminish a little bit, right? Because in Canada, we don't have a whole lot of opportunities, just particularly when you work just a T4 job, right? It's going to be hard to find a lot of opportunities to manage your taxes. But there are a few things you can do, and some of those we'll go through today. How can I reduce the amount of taxes I pay when I own it? Yeah, I just went through that. There was efficient way to build liquidity. of $1 million. Again, that is personal financial planning issues that will require one-on-one consulting. And then the last one there talks about cycle of paying back large sum amount to CRA. Essentially, how can I stop paying money back to CRA? Again, that may not be such a bad thing, but again, if you're paying too much in taxes, then there may be opportunities for you to minimize your taxes. So those are just a sample of some of the things people have in their mind. People are wrestling with some of these ideas, some of these questions, and so hopefully we can address some of those today. Now, I like to go back to foundation. I believe, as a firm, we believe in arming our clients and giving them knowledge that they need. Okay, so I think that is critical. Whether you're working with us directly, whether you're working with a different tax professional, it is always important for you to have some basic understanding, so that way you can ask better questions, you can challenge people you work with from time to time. So one of the important points is the basis of tax in Canada. Okay, so the basis of tax in Canada is residency. If you're a resident in Canada, then you have to file and pay taxes, okay, regardless of where that money is earned. Okay, so a lot of people work in the US and earn money in the US, but if you're a resident in Canada, whether you're earning income in the US or in a different country, then all your taxes, all that income is taxable in Canada. Okay, so that's the basis of tax, is residency, and we are all taxed on our worldwide income, regardless of where that money is coming from. We have a marginal tax rate in Canada. So what that means is the more money you make, the higher tax rate that will be applied to that additional dollar of income. Okay, so that is the kind of tax rate we have. So the marginal tax rate. Let me see if I can explain it in another way. So, and I'm going to show you the table here. So you're going to see that. I think when I show you that will probably explain it a little bit. So just have this at the back of your mind. If you make more money, then you have additional or higher tax rate applied to the additional dollar that you earn. Okay, and that goes all the way to 54, or about 54% in this country. The 2024 personal tax rates. So this is the table here that shows the personal tax rate. So this is just an average, trying to combine both federal and provincial and Ontario taxes. So this is what I mean by the marginal tax rates. Okay, so let's say you make $86,000. So that's the fifth bullet point there, right? So if you make $86,000 to $98,000, it means for any amount you make from $86,000, your tax rate is going to be 31.48%. Okay, on that additional dollar for that range. And it goes on that way up to the top rate. So any amount you make over $235,000, your tax rate at that point is going to be 53.53%. Okay, so this is essentially how our marginal tax rate works. Right, so everyone, when we're filing personal taxes, everyone gets a personal tax amount, which is $13,000. So you can earn up to $13,000 and pay no taxes. Okay, so that's just the minimum amount you can earn without paying taxes in this country. So anything above that, and then the marginal tax rate goes on and applies to any additional income that you earn. Okay, so as you're looking at these rates, you begin to get some ideas now why it is important to begin to think of ways to plan your taxes, to manage your marginal tax rates, and to make sure that your income is not exposed to the high tax rates. And some of those ideas we'll go through here today. How do we calculate your personal taxes? How is that done in Canada? Okay, so you start by your income. So you have your total income, and as we start. But now with those total income, you may have deductions against your total income. All right, so those deductions will now get you to a place what we call taxable income. And it is that taxable income now that these rates that we just went through will now apply. Okay, so you have your total income. You may have some deductions against those income to arrive at the taxable income. And then those rates will now be applied on your taxable income to determine your taxes. Okay, so now you may determine your taxes. You may turn out that you owe, let's say, $50,000 in taxes. And then you may have tax credits to now help you offset some of those taxes. And then at the end of the day, once you offset with your tax credits, then whatever is left is what you now have to remit and pay to the government. Okay, so on a high level, that is how our tax liability is calculated here in Canada. Another important thing to note is that not all income is taxed alike. Okay, again, this is another important tax planning point. Employment income is the most taxed in Canada. Interest income is very highly taxed. Dividend income is not taxed as much as employment or interest income. Capital gains, right? So if you buy a capital property like real estate, you hold it for a couple of years, you sell it, then that proceeds from that sale is taxed differently. Okay, so all different types of income are taxed differently. So this is something to really, really understand and to know when it comes to Canadian taxes. Another important thing to understand is the difference between tax credits and tax deductions. So earlier I explained how our taxes are calculated, right? So tax deductions will reduce your total income and bring it down to what we call the taxable income. Tax credits, on the other hand, is a $1 for $1 that you can use to offset your personal taxes. Okay, so at the end of the day, you use deduction to reduce your total income to your taxable income. The tax rates will now apply on that taxable income, and then you can use tax credits to offset the taxes that you may be owing. Okay, so those are the difference. So tax credits will offset your taxes. Tax deductions you use to reduce your total income to taxable income. Finally, I just want to go through this point, tax deferred versus tax free, right? So oftentimes people think this is the same, one and the same thing. They are different, right? Tax deferred simply means that you're not paying the taxes today. You're just deferring that burden to sometime in the future. Okay, tax-free means you don't have to pay taxes at all, right? It's totally tax-free. And so the two vehicles that you're all familiar with is the RRSP and the tax-free savings accounts. So the RRSP, which is the Registered Retirement Savings Account, is a tax deferral vehicle, right? So what that means is when you make contribution to an RRSP, that contribution you can use to reduce your taxes today, but you're not actually, is not tax-free, right? You're just reducing your taxes today and pushing it forward to sometime in the future. Okay, because when you withdraw from that account, you will now be liable to pay the tax at that point. Tax-free, on the other hand, means you don't owe any taxes. You don't have to pay any taxes, not today, not in the future. Okay, so TFSA is one of those accounts where you contribute with your after-tax dollars, but that account now grows tax-free. Okay, so you don't have to pay taxes on any growth in that account, not today, not in the future. Okay, so those are the two important, the distinction between tax deferred and tax-free. They're two different things. Okay, so now let's jump in and talk about what is new this tax season. And I think, Nibia, this is where you come in. So Nibia will walk through some of these items.
Okay, so the first one is the multi-generational home renovation tax credit. So like the name suggests, it's new for 2023. So it's where you get up to 7,500 in tax credit, or up to 50,000, where you can claim up to 50,000 in renovation costs and an eligible dwelling to establish a secondary unit that enables a qualifying individual to live with a qualifying relation. So a qualifying individual would be like a senior, your mom or grandparent, or someone who is eligible for the disability tax credit, right? It must be a self-contained unit, so they must have their own privacy, etc. What I want to bring out for this one though, not all expenses are eligible. So some of the expenses which are not eligible is like any annual recurring routine or maintenance that you would do on your house. That's not eligible, as well as household appliances that you may put in the unit, or financing costs. So if you borrowed money to renovate, the interest on that money is not eligible, and expenses not supported by receipts. So you have to have your receipts for this one. Ken? Okay, so another one for 2023. So in 2021, 2022, I believe, we were eligible to claim up to $2 per day for up to 225 days for as work from home expenses. So if you were working from home, you could claim $2 per day. Up to a maximum of $500 you'll get as a deduction. For 2023, that's no longer available. It was just something they put in place for COVID-19 and seeing that that's over now, so that's no longer eligible. So now we go back to what we were originally doing, the detailed method. And for this one to claim work from home expenses, you have to get the T2200 form from your employer to claim those work from home expenses. So some of us got some COVID-19 support payments during 2020, 2021, 2022. For example, the CERBs, CEBA, etc. Whether you got it for personal or business. In 2021, so I think the government started last year where they started writing to persons that they have to repay back some of this money. So when we got the money originally, we had to claim it as part of our income. So now that we have to repay those money, whoever has to repay, you can claim it as a deduction to your income. So to put you in a lower tax bracket for this year, for 2023. So if you're owing CRA any money currently, between the first quarter of 2024, the interest rate has gone up by 1% to 10%. So that will be, depending on how much you're owing, it could be a really big cost for you. So what they're trying to do is to get you to pay up any money that you're owing to them right now. So for electronic filing, payments, communications with CRA, this year they for 2023, 2024, they're making a lot of changes. So for starting January 1st, if you're owing CRA, if you have to pay CRA anything over $10,000, you have to do it electronically. So if previously you were writing checks to CRA, there may be a penalty to do that unless you can explain to them or give them a valid reason why it is that you have to pay it that way. Otherwise, they want you to pay it electronically, so you can pay it through your online banking, or you can still write a check, but you'd have to go to the bank and ask the bank to pay it for you. Also, if you're like an entrepreneur or sole proprietor and you're issuing tax slips, whether T4, T5, etc. If you're filing more than 5 slips for this year, you have to do it electronically. Previously, you could have mailed in the slips to CRA up to, I believe, up to 50 slips you could mail into them. This year, anything over 5, you have to file it electronically. If so, I think Ken skipped one. There was a tradesperson tax, tradesperson, where now they have increased it from $500 to $1,000, where you can claim as eligible expense deduction for whatever you have spent on tools for that for 2023. So it has doubled for 2023 and beyond. The first home savings account. So previously Ken was talking about tax deduction, the RSP, and the TFSA account. Those are two methods you could use to reduce your taxable income. For 2023, started in on April 1st, the government have introduced another one, which is the first home savings account. But this one is for first home buyers. So basically, if you have never ever owned a home, you'll be eligible for this one. Or if you have not owned your own home within the last 4 years, you could be considered eligible for this as well. How it works, you'd have to be a Canadian resident for tax purposes between the age of 18 to 71, or for some provinces, it could be starting at age 19. And so basically that's the criteria for it. So how it works, you'd have to open up a first home savings account at your bank, just like you do for a RSP or a TFSA. It's a registered account as well. And the thing about this one, it comes by the benefit of the RRSP and the TFSA. So for each year, you can get up to $8,000 in deduction. So you can put up to $8,000 in the account for each year, up to a maximum of $40,000 over the years. However, you have to use up this money within 15 years. So if it comes to 15 years and you haven't used this money, you'd have to, one of the measures you can do is to transfer the money to like your RRSP account. And there won't be any penalty to do that. But if you're someone who are planning to buy a home soon, I would say definitely open up this account. I mean, it gives you $8,000 in deduction for the year. So this one missed me in 2023, but definitely, and even if it's not something that you already have your home, it's something you could advise your kids to do as well. Just start contributing to this account as well. So any gains in this account, it's tax-free, and it's tax-free basically. So, but once you withdraw from the account, once you buy your first home, then you lose, then that's it. So, right. So once you buy your first home, then that's it for this first home savings account. And then we have the disability tax credit. So it's not entirely new, but I think it started in 2022. But previously, persons with this type 1 disability, you'd have to meet certain criteria for the government to consider you to be eligible for the disability tax credit. However, they have taken away those, and once your doctor has diagnosed you having type 1 disability, you're eligible to get the disability tax credit. So if you purchase a zero emission vehicle, electric vehicle, up until March 2025, you can get up to $5,000 tax credit, depending on how much the cost of the vehicle was. So again, this is just another thing for you to know if you're interested in getting a zero emission vehicle. Again, of course, the government is encouraging everyone to go this route, and this is one of the incentives to do that. For our SB, so as we know, so for our SB, it's based on our income from the previous year. So for your 2023 tax RSP limit, it would be 18% of what your income was in 2022, but up to a maximum, right? So for 2023, your maximum is 30,780, and it's expected to go up for 2024 as well. Similarly for TFSA, the maximum for 2023 is now 88,000. Again, it increases each year, but of course, if you have any investment at all in your TFSA, your contribution room would fall. So Ken will take over for the anti-flipping legislation, as well as the luxury tax.
Okay, so thank you so much, Nivea, for that. So this is something that is new. So this was proposed in the budget in 2022, just to deny capital gains treatment for a lot of people that were buying homes, living in it for a few months, then they will turn around, they'll sell it, and then they will move on, they won't declare the gains. Okay, so that loophole has now been closed. So what that means is if you buy real estate, whether you're living in it, whether it's for rental purpose, whatever it is, if you buy it and sell it within 365 days, then you're not going to be taxed on capital, right? It's going to be considered income. So any gain on that sale will be 100% taxed. So remember with real estate, if you buy real estate for rental purposes, so this for rental purposes, if you buy real estate for rental purposes and rent it out as a capital asset and sell it, you're eligible for the capital gains treatment. So that means you're only paying taxes on half of the gain, not the entire gain. Okay, and as some of you know, if you own a principal residence in Canada, if you sell your principal residence, you don't pay taxes on your principal residence. Okay, so before this time, a lot of people will buy houses, they will live in it for 6 months, 8 months, and then they will turn around, they will sell it. Okay, particularly when the housing market has really been moving up over the years, a lot of people did that, right? And so they were able to just avoid paying taxes on those gains. But that loophole has now been closed. So you have to own that property and live in it for at least 365 days. For you to qualify as a principal residence and to qualify for that exemption where you don't have to pay taxes on the gain. So luxury tax, again, came into effect in 2022. It's not entirely new, but it's still fairly new. So that's why we put it here. So this will apply to cars, luxury items that are priced over 100 grand. Boats over $250,000, and then then 20% of the value over the sales price, or 10% of the full value, is what you pay as tax. Underused housing tax is something that is also very new. Okay, so we had to do this filing for the first time last year. So this is a new tax that came into effect where it applies a 1% tax on the value of any home if that home is considered vacant. Okay. Now, if you own your property in your name, a lot of people that own properties in their personal name, for the most part, most of you will be excluded so long as you're a Canadian citizen or a permanent resident. The only time where you may fall into this tax is when you hold the property as a trustee, right? So we see a lot of joint venture arrangements where people go into joint ventures to buy properties. And then in that case, they are holding property with friends. Maybe they're holding it in trust for their corporation, or interest for their mom or parents. So all of these things. So if you're holding a property in trust, then you're going to be caught under this new law where you'll be required to file this new tax return. Now, you don't have to pay, you don't necessarily have to pay the taxes if the house is not vacant, but you still have to file the tax return. Okay, so if you are an affected owner, then you'll be required to file the tax return. But if your house is not vacant, then you may not have any tax obligations to pay. Okay, so last year, because last year was the first time they sort of extended the filing deadline. So this year, I think they will go back to that. They're not back to that normal, regular filing deadline of April 30th, which coincides with our personal tax filing deadline. So this season is going to be the first time we're going to be doing both at the same time. So for those that, if you think you're going to be caught under this, then I would really encourage you to start thinking about filing as early as possible. Because with the two timelines for personal tax returns and for this UHT, it's going to be a little bit challenging for, particularly for us, since we're the ones handling and doing all these filings for clients. Even for those of you that will be filing yourselves, just consider, make sure you're ready to get this filed as soon as possible. So these are some important dates to have in mind. So personal tax returns due April 30th. So that's the filing due date. That's also the date you have to pay any taxes you may be owing. Okay, so April 30th, have that somewhere marked on your calendars. If you're a sole proprietor, your filing deadline is June 15th. However, if you're owing taxes, those taxes have to be paid by April 30th. Now, I get this question all the time. Well, if I have not filed, how do I know how much I'm owing? Right, so it's likely you may not know, but you may be able to estimate. And so that's some of the things we do too. We can help you estimate the taxes you may be owing so that you can get that paid ahead of time. And then once you have all your documents together, you can file before the deadline of June 15th. The same applies for HST. Okay, so if you have a HST account, again, your filing deadline, so this is personal HST as a sole proprietor, filing deadline is June 15th, but again, any taxes owing have to be paid by April 30th. So now I just want to spend some time now to talk about some tax tips, some planning ideas to consider. Because for us as a firm, our focus is not just on compliance, it's about saving you taxes, right? So I personally believe the more taxes you can save, the more you can put that dollar to work for yourself, for your family, for the charities you're interested in supporting. So it's always important to talk about tax planning ideas and some tips to help you save on taxes. So remember, one of the biggest concerns Canadians have is getting organized, right? And so one of the things we encourage you to do is February now. You still have some time, but this is the month to really get organized, right? So February, early March, to get organized, start getting all your documents together. If you have all your documents electronically, I encourage you to maintain an electronic file where you put all your documents. If you do the paper file, then get a folder and start collecting all your necessary documents. A lot of tax preparers these days, I don't know people that do paper anymore. We don't do as much. We still get people that come to our office with papers, but that is rare. So we work mostly virtually now. And so a lot of documents will get electronically. Okay, so even if you collect your papers, your documents by paper, maybe a good thing to do is to scan them and organize them electronically. Okay, so one of the reasons why you need to file on time is to avoid penalties and interest, right? So if you file late, then those interest and penalties are as high as even 10% now, based on the increases from CRA. Okay, so just try to file on time. Another reason why it's important to file on time is to avoid reviews and audits. Okay, so oftentimes if you don't file on time, you're getting letters from CRA, then they're just going to highlight you, and then they're just going to start focusing on you, right? So anytime you file something, then they may have more questions. And so reviews, audits, these are all additional burdens for you as a taxpayer. Is a burden for us as even as tax preparers, right? If we have to deal with this for our clients. But again, it's something that we do. We can always help you with your reviews and audits, but you can avoid those headaches if you file on time and if you stay organized. Now, earlier I talked about deductions, okay? So some of you may not be familiar with the deductions. So one of the things we'll do, if you work with us, we give you a comprehensive list, a checklist that will provide you that lists almost all the deductions. And so it's good for you to go through that list and then think about things that may be applicable to you. Okay, so some of you are already familiar with the very common ones, things like RRSPs, the RDSPs for Disability Savings Plan. The support payments, if you're making support payments, some of those things you can deduct. Employment expenses, right? So make sure you get that T2200 from your employer if you have those employment expenses to deduct. Again, this $2 per day is no longer applicable for 2023. Carrying charges and interest, right? So I see a lot of people miss this. If you're taking funds, some of your personal funds, and you're investing it in your business or in a real estate investment, just remember that the interest you're paying on those funds you can deduct, right? So anytime you deploy capital to earn income, remember that if you're borrowing that capital, if you're borrowing money from the banks and you're using that money to invest in an initiative to earn income, then that interest you can deduct. So always remember that. A lot of people don't always forget that. Then there are certain legal expenses you can also deduct, particularly if it's a legal expense incurred to maybe to get income or lost income from your employer or anything related to employment income, right? Some of those legal expenses you can also deduct. If you run a business, then there are a lot of expenses you can deduct related to your business, so long as those expenses were incurred to earn income or towards your business. Okay, so the same thing with the rental property. If you have a rental property that's an investment, again, there are expenses that you may be eligible to deduct. So all the interest on the mortgage, property taxes, all of these expenses, day-to-day operation that you spend on running your properties, you can deduct. If you run a business, don't forget your vehicle expenses, right? So vehicle expenses, particularly if you're using the car, for your business. So try to gather all the documents for all your expenses, and hopefully you're keeping record of how much you're tracking as it relates to your business, because that's the percentage that will be used to allocate all your vehicle expenses. So always have in mind that there are lots of deductions that you can use to reduce your total income to the taxable income before those tax rates will be applied. Similarly, there are credits. Okay, so credits, as I mentioned earlier, will reduce your taxes payable. Okay, so again, if you work with us, we'll give you that comprehensive checklist that has, again, a list of some of these credits that may be applicable to you. If you subscribe to digital news, you can claim up to $500 for that. The Canada training credits, so that's not new, so that has been around for a number of years. Or your donations, medical expenses. Now with the new home savings account, FHSA, all of these things can help you. No, well, that's the deduction. But so we have the home buyers credits. This used to be the old one. I don't think it's been erased, so that one is still there. So home buyers credit. So if you buy home for the very first time, you get a credit, and I think it was increased from from 5,000. I believe it's gone up to 10,000 now. I'm going to cross-check that. But if you're buying home for the first time, so remember you get a home buyer's credit that you can use to offset your taxes. Then we have the other ones that's been around for a while. Eligibility supply credit. Ontario staycation credit, I think that is gone. That is no longer applicable for 2023. Then we have the disability tax credit that has always been there, and then the zero emission vehicle tax credits. So when you're thinking about taxes, think about reducing your taxes, not just for 2023, but for 2024 and the years ahead. Okay, and so that's why it makes sense to start to plan ahead, right? So you will sort of, if you start planning ahead, then you have enough time to begin to think about ways to minimize your taxes. So we always encourage you to start planning ahead. So 2023 is somewhat late now, but at least there may be a few things you can do. For those of you that have not contributed to your RRSPs, you have a couple of days before the 29th to do that. But when it comes to tax planning, start thinking about 2024, right? And the years ahead and how you can use some of these things to save taxes, right? So TFSA, consider using TFSA. Okay, so I always get this question all the time. Should I contribute to my TFSA or to my RRSP? At the end of the day, it depends. But we encourage you to, particularly if you earn, so for me personally, I think if you're earning very high income, I think you should start with your RRSP first, just to bring that income down. And obviously you have to watch how much you contribute to your RRSP. You don't want to have that account out of whack, right? So you have to manage it and watch it, because at the end of the day, remember, it's just tax deferral. It's not tax free, it's tax deferral. So you don't want to allow that account to grow too much, because if it grows excessively, and then you end up in a place where you begin to pay taxes once you start drawing down on it. And as you know, tax rates are not going to come down, they will likely go up over time. Okay, so that's why it's important to plan your RRSPs. TFSAs, I think if you have high income, once you use up all your room, then it makes sense to just go into your TFSA, right? If you have low income, I will encourage you to just start with CFSA. Okay, so start with TFSA and start saving, because you may need it to buy something in the future or something in the near term. So you can use your TFSA as a way to plan and to save. If you have a passion, I always encourage you to start a side business. Okay, so if there's something that you're already doing, spending time with, whether you're doing it together with your kids or something, think of ways you can consider or convert some of your side gigs or some of your passion into a business, right? And now, because now it's a business, then there may be opportunities for you to really begin to deduct some things that you were not deducting before. Okay, so that's always something to consider, particularly if all your income is just T4 income. So that's something to consider. Consider how you can start a business on the side. And if you have family members, also consider how you can get your family members involved, right? So our tax system in Canada is a little bit more biased towards families. Sometimes I like to crack jokes with single people. I say, well, what are you waiting for? Why don't you just get married and start having kids? And Canada will be happy for you. Your pockets will be much better for it. So our tax system is biased towards families. Okay, so if you have family members, consider ways you can use them so that way your family taxes can be minimized. Where possible, contribute securities with a lot of growth and contribute that to charities, because with that, you don't have to pay taxes on all of that growth, particularly if you have those in your non-registered accounts. Okay, so that's another tax tip to consider. I like to talk about this one. I know home prices have really gone high, but if you don't own a home, I will really encourage you to get into one, right? I know it's kind of challenging to get into homes now because of the high prices, but there are so many ideas that you can explore, right? Whether you want to get someone else to share equity with you want to get friends together, family members together, but consider ways to get into home. Remember, if it's your primary residence, you don't pay taxes when you sell. You can leverage it to get into other investments. And over time, we know that home and house prices will continue to go up over time. So that's something to consider. And if you have your home, why don't you consider buying more homes, right? And then turn into a business of you get into the rental business. And again, once you're in the rental business, then now you can deduct other things that are business related and save taxes and continue to leverage and continue to build tax efficient wealth that way. Employees. So if all you have is a T4 income, then yes, you don't have a lot of room in terms of saving taxes. But again, as an employee, know that there are lots of tax benefits as well that you can get as an employee, right? So, but that will require you to negotiate with your employer and to come up with ideas. So in that article that I linked there, I share 7 ways you can lower your taxes as an employee. Right, so I encourage all of you to click on that link and read through that and see if there are ideas you can bring up to your employer and say, okay, why don't I do this? Or why don't we do this? And then that way, some of your benefits that you're paying taxes on can be converted to non-taxable benefits. FHSA, Nibia talked about that. Again, if you're looking to buy a home for the first time, I highly encourage you to set up that account. And then the home buyers plan, I think that's something that used to be the old one, but I think it's still there. Is not been eliminated yet. So you can withdraw up to that $5,000 from that plan, from your RSP, again, to use that towards your home purchase. Okay. I talked about marginal tax rates before. So if you know now the way we calculate our taxes, that you start with your total income, and then you cannot deduct certain things to arrive at your taxable income. So if you understand where you stand on that marginal tax rate bracket, then now you can start thinking about some deductions you can use to at least move from a higher marginal tax rate to the next one. And I think once you make that move or move 1 or 2 steps down, you can save yourself thousands of dollars in taxes. So consider ways you can manage your marginal tax brackets by using certain deductions you may be eligible for in reducing your taxes. So in terms of tax efficiency, so this is something I do on a consultation basis, but I just want to briefly talk about what it means to be tax efficient. Okay, so tax efficient is an intentional financial plan that is designed to help you minimize or eliminate taxes. Okay, so a lot of the ideas we talked about today, you can employ some of those ideas to figure out how you continue to stay tax efficient, not just today, but in the years ahead. Okay, and when you're fully employing or putting this to work, then essentially you're coming up with ways that you want to save money or totally eliminate taxes. Right, you want to save money tax-free or tax efficiently, right? That's the whole idea. And one of the tools we use that you can use the TFSA to do that, right? You can also use an insurance plan to do that, right? So figure out ways you can save money tax efficiently or tax-free. Then again, you got to think of ways to grow that money tax-free. Okay, so the TFSA is one of those accounts where you grow your money tax-free. But you can also think of ways you can grow that money tax efficiently, right? So for example, you own real estate grows. and that growth now becomes capital gain, right? You don't have to pay taxes on the account of income. It becomes on the account of capital, right? And then finally, you got to think of ways to distribute money tax-free. Okay, so now once you retire and you start getting income, how do you pull that money and pull it in such a way that you pay little or no taxes? Okay, and so this is a tax efficient plan. And it takes planning to get to that point. It's not something that you can achieve right away. And so that's why I encourage everyone to start considering ways to live what I call the tax efficient life. Okay. And feel free to talk to us anytime, and we can figure out ways to support you. So as a team, we're here to support you. Okay, so this is the rates or the plans that we have for tax for personal taxes. So our basic plan, assuming you just have a basic tax return. So our basic plan starts at $275 per tax return, and then it goes up to $695, and then to $1,975. And so these are all the things you get, right? So with the basic tax return is just one tax return. With the standard rate, you get up to 2 tax returns, and then you get all these other additional benefits. And then the premium one, again, a lot of benefits. You get up to 3 additional tax returns. Ideally it's very ideal for large families. And then you get all these other additional tax benefits. And then for those of you that are just looking to grow your wealth tax efficiently, so this is I run a tax efficient wealth membership platform. And so this is the rates to join that platform. So these are annual rates, and these are the different plans that we have. So these are the links. Some of those links will change, but these are the links to access any of the services that we have. So our coaching services, our membership services for the tax efficient world, and then our personal tax returns. I also share some additional information here. So for those of you that have not seen or read my book, a lot of the ideas I shared here today, you can get a copy of this book, and then you can read it. It takes only 2 hours at most. You can read and get some ideas about more foundations, some of the big obstacles when it comes to growing your wealth tax efficiently. I talk about the tools, the blueprints, and how you can go about implementing these ideas. Again, this is my contact information as well as Nibia's. So our office is in Mississauga. We're hardly there these days, but give us a call. We can always meet if you want to meet in person. But that's all our information. That's our website to learn more about our firm. And then that's our general email address if you want to get in touch with us. And this is the rest of our team. I think most of them are here. So Allah helps with our personal taxes as well as support for our business owners. She does all the business analysis and planning related. Aprita is a new member of our team. Today is actually her first day joining the team. So she's joined us. We're happy to have her. So she's gonna be again taking on some personal tax responsibilities and some accounting support for our business owners. Celia is my business partner, so she runs our not-for-profit practice. So those are all the assurance services we provide for not-for-profit. So for those of you that have anything at all to do with not-for-profits, I invite you to join us tomorrow. We're going to be focused mostly on not-for-profits. So remember to register. We'll have those links if you go to our website. You should be able to find a link there to register. And maybe someone in my team, if you guys can drop that link on the chat, that'll be great as well. Neha is our audit lead. So Neha works closely with Celia. So she's the go-to person when it comes to all our assurance services, particularly our audits. And Varinda is our lead when it comes to corporate taxes. So again, for those of you that are here, if you own a corporation, I invite you to join us here on Thursday when we're going to be talking about corporations and how you can use your corporation as a tool to plan and to save on taxes.
Ken,
All
there
right.
was a question. There's a question.
Okay, so I think we're going to open it up now for questions.
Sean had a question.
Okay, so if you have questions, you can actually unmute yourself and ask your questions directly, or you can drop it in the chat, and then we can go in and take a look at that. Okay, so can you please touch on how you can save taxes with investment properties? Okay, so someone talked about here how you can save taxes with investment properties. So if you remember, I mentioned here with investment properties. If you remember, I talked about different types of income that are taxed differently. Okay, now if you own an investment property, you don't pay full taxes. You pay what we call the capital gains tax. So essentially, you're only paying taxes on half of the gain when you sell your property. Okay, so that is one important benefit when you own an investment property, right? Because you pay capital gains taxes. Secondly, if you own multiple properties, right? So if you own one or two, you may not benefit a whole lot when it comes to running it and using it as a business. But if you own multiple properties, it becomes a business. And now if you think about a business, what can you deduct as a business owner, right? Anything that you can use or that is necessary to generate that income, right? So you're driving to your rental properties, you can deduct your vehicles. Maybe you have kids, you can get them involved in property management. And then one of the big benefits is what we call the CCA, the deduction, the amortization that you get with real estate properties, right? So that will allow you to defer taxes for many, many years, right? Amortization will not help you save taxes. It's not tax-free, but what amortization does for you, it helps you defer taxes, right? So if I buy a property for $1 million today, right, I can take 4% of that value and write it off as an expense. Okay, so with that, you can defer taxes. And if you continue to buy more and more properties, then you may not even pay taxes for many, many years to come. Okay, so those are some of the ideas when it comes to investment properties. So someone said they were unable to click on the 7 ways. Okay. You may not be able to click on it now, but when we share the slides with you, you'll be able to click on it. You'll be able to click on the link. Okay, so at the end of the presentation, for those of you that are registered, we're going to share the slides with you. And once you have the slides, those links will be clickable. And so once you click on that link, you should be able to go to that site. So someone has a question here. What's the difference between aiming to pay less taxes and getting higher tax return?
I think she probably means a higher tax refund.
Tax refund.
Sean, can you explain? I think she means higher tax.
That's correct. That's correct, Celia.
Yeah.
Okay, all right.
I asked the question because in the beginning, when you went through the surveys, you mentioned that if the aim is to get a higher tax refund, then you're not planning taxes properly. So I just need for you to explain a bit more about that.
Okay, all right. Yeah, I can talk about that. So that's an important point. Now, if your goal is to get a tax refund, so let's say you get a lot of tax refund. What does that mean? That simply means that you've given CRA too much of your money. Okay, that's essentially what it means. So if you're getting tax refund, it means that CRA is taking too much of your money upfront. They're not paying you interest. Then at the end of the year, you're filing taxes and you're getting this huge tax return. And I understand it. I get a lot of clients that's all they look forward to, that's all they want. And even when I advise them differently, they don't want it. They just want to get that tax refund. And I understand that, right? But the idea is this: if you're getting tax refund, it simply means that the government is taking more of your money upfront. And then at the end of the year, they will hold it for like 13 months or 15, 16 months, and then they will give it back to you with no interest. Okay, so now my question for you is this: would you rather have your money with you, or would you rather have the government hold your money for you? Okay, so if you're getting too much refund, there are things you can do to reduce that, right? So there's an employment form, I don't remember the number now, that you can send to your employer, and they can reduce some of those deductions, so that way you can start getting most of your money upfront. And then at the end of the year, if it turns out that you're owing CRA, maybe you have the savings somewhere, you're investing it somewhere, then you can now turn around and pay CRA their money. Okay, so that's what I mean by that. Hopefully that is that helps clarify it.
Yeah. So, sorry, Ken, can you hear me?
Yes, I can hear you.
All right, perfect.
Hey, good to see you. How are you?
Yeah, doing well. Ken, thanks again for a good informative presentation, and to the team as well. Just a couple of very silly questions. So maybe I misunderstood. So if I'm deploying my own capital and making non-registered investments, did you suggest that I could actually deduct interest expenses for the capital that I allocate towards these non-registered investments? Say I'm not taking a loan, but I'm just deploying my own personal savings. I can deduct interest expenses, is it?
No, you can't. You can only deduct expense if the money is borrowed.
Okay,
right.
Got it. So maybe I misunderstood. Okay, got it.
That's right. So that's when you have interest. Because if you're using your savings, you're not paying interest to anyone. Okay. Is your capital, is your money.
And establishing a business, and pursuing your passions, is there a rule of thumb based on all your experiences? If the CRA flags you, if you're showing continuing losses?
Well, if you're showing continuous losses for several years, then CRA may actually challenge you to say you're probably not in a business to generate income. Okay, so you have to be mindful. You always have to be in a business to generate income. That is the goal. Oftentimes we'll start out in business and we don't necessarily generate income right away. But if you can show proof, you're putting in effort, you're advertising, you're actually generating income, and you're doing all these things, and you have the structure and the posture of a business person out there working towards generating income, then yes, you can go back and challenge CRA. Yes, I'm actually trying to do this business to generate income. Okay, perfect. I know you have to be mindful if you're making, let's say you've been doing it for 6, 7, 8 years and you're all having losses, then CRA will come and challenge you. Are you sure this is a business or is it a passion? So that's something you have to be mindful
Absolutely.
of.
And just a quick administrative point, the deductions list that you guys offer your clients, is that something that you normally circulate prior to or during the process of doing the taxes? Like, is it something that you circulate prior to the clients kind of, collating their documents?
Yes, we start doing that. I think those should be going out. Correct me if I'm wrong. I don't know who is it, Nibia or
they've already gone out. I think Nibia already sent them out, right, Nibia?
Okay. Sorry.
Okay, so they may have gone out to some clients. So Rohit, if you don't have it, then I'll make sure you get it.
Okay, perfect.
So it's a checklist that was sent, and that checklist has a list of all those deductions and credits.
Thank you so much.
Yeah, you're welcome. All right, so let me see here if there are more questions. because we only pay 50% again. Okay, so I don't see any more questions on the chat.
There is one
Um,
that asks, do you offer cross-border tax services?
So we don't do US taxes. Okay, so we don't have the expertise to do US taxes. I think the complexities of dealing with Canadian taxes is enough for us for now. But if you do have US tax obligations, we can certainly support you. So the only thing we'll do, we can refer you to someone that will do taxes for you in the US, or if you know someone that will do your taxes in the US, that's fine. But at the end of the day, we still have to file your Canadian taxes, particularly if you're a Canadian resident. If you're a Canadian resident, then all the taxes, all the income in the US, we have to report here in your Canadian tax return. But again, you're going to get a credit for all the taxes you paid in the US. So oftentimes we're going to request for your tax returns in the US, both federal and state tax returns, so that way, once we're preparing your taxes, we'll make sure that we've correctly factored in your US income, as well as giving you credit for all the taxes you paid in the US. Okay, all right, so if you're here, if you have questions, let's give you one more chance to speak up and ask your question before we end the presentation for tonight.
Hi, can you hear me?
Yes, I can hear you.
Yeah, a follow-up to the question you just answered. If you have your family living in Canada and say you're working in the US, would you still consider yourself as a resident of Canada for tax purposes?
Well, are you a permanent resident here? Are you
like a citizen?
Oh, you're a citizen?
Yeah.
Well, if your family is here, that means you have significant ties in Canada, all right? And so residency is sort of based on significant ties. So if you've not broken those ties, then you're going to be considered a resident for tax purposes. So that's something that you may want to look into closely, just to make sure that that you're properly disclosing and reporting all your income. Again, if you have significant ties in Canada, then most likely you're going to be considered a resident for tax purposes. And so having family members here, kids, maybe you have a home here, all of those things are significant ties for sure. Does that answer your question?
Yeah, it does. Thank you.
Okay.
But if you have a home, but the home is rented out, and you and your family members, say your spouse and kids, are living in the US, for example, will you still be considered a resident of Canada for tax purposes?
Unlikely.
No, not really. But you have to break those ties. You have to actually, I think there's a form with CRA that I always recommend my clients to file to complete that form. So that way CRA will acknowledge that you're no longer a resident for tax purposes. But if you have your property here, you're going to file what we call the non-resident tax return for that property income, for the rental income. Okay, so now you don't have to report your worldwide income. You're now a non-resident for tax purposes, but you file a non-resident tax return just to report your rental income and your rental operation.
Okay, so the situation is, give an example of a human being who has his primary home here, but has moved to the US, and I rented out that property. So initially it was his primary home, but now it's rented. So at what point, when he sells that property, at what point of like the capital gains would it be taxed, or as like a rental property, or portion of it will go as his primary home?
Well, the day he moved out, right, that will be considered the new cost for that property. So he's not going to pay any capital gains up to when he moved out from that property and left the country. Okay. So, but that's your friend. I have to just make sure that he has done the right paperwork, not to be considered a resident for tax purposes. So that's why I always encourage that filing. And I always ask that you file it as soon as possible. Oftentimes, I encourage you to do it before you leave because it's always important to get that letter from CRA. But that can still be done, right? So he has established, just make sure that he has established a clean break. So there are no other ties. He has a property here that is renting, that he's renting. So long as he's moved all his family, he's closed his bank accounts, and then cut a few other ties, then he may be considered a non-resident for tax purposes. Then in that case, all he needs to file is just to file a non-resident tax return to report his rental operation here, since he has income in Canada from rental.
Okay, thank you. And the tax services you showed earlier, is that for both? Like the 1,400, is that for personal and corporation taxes, or that is built?
No, it's personal.
Separately?
Everything here is personal. Everything we talked about here is personal taxes.
So if you have like a side gig that you do, corporate business, and you want to file taxes for that first and then file your personal taxes, and do you have a separate service for that?
Well, if your business is a corporation, then yes, we have a separate service for corporate business owners. But if you run your business as a sole proprietor, then we include it in the filing of your personal tax. Okay, so there's an additional fee if you own a business as a sole proprietor, because we have to create a new schedule for you in your tax return. So your fees will no longer be $275. So there's an additional $500 that will be added to that rate if you own a business. Then again, if you need things like bookkeeping to get all your income and expenses, that's an additional service that we offer. So all of those additional services we can always discuss if you have those needs. Just reach out to us and we can talk about it.
Okay, all right. Thank you. I appreciate the answers.
You're welcome. All right, so any other question? I think we can take maybe two more or one more before we wrap it up for today. Okay, so if there are no questions, I want to thank all of you for showing up today. Hopefully this has been useful. Again, if you have any questions, feel free to reach out to me, to Nibia, to any member of our team. Go to our website to learn more about our services and what we offer. And if you're involved in not-for-profits, remember to join us tomorrow when we talk about not-for-profit governance. And if you own a corporation or know someone that owns a corporation, remember to join us on Thursday as well. Okay, so thank you all for joining. Thank you to my team for putting this together. And hopefully we'll see you guys around. Okay, bye everyone.
Bye.